Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts and I'm joined by Judi Seebus, James Wallace and Nicol Dynes, and we'll have a special focus on the H1 numbers. But let's start with the roundup of the week. James, what have you been seeing in terms of those macro numbers?
Just kicking off with America, actually, it was last Thursday, the US reported Q2 GDP contraction of 9.5%, which at an annualized rate is 32.9%. So that's the fastest annual decline on record. In Europe, Germany's Q2 numbers was the mildest at minus 10.1. Italy plunged 12.4% in Q2. That's actually a little bit lighter than a lot of people suspected. And I think that in part was actually because a lot of it was the first country within Europe to be the sort of epicenter of COVID. And actually, a lot of their kind of shutdown was at the back end of Q1. France suffered its largest post-war contraction in Q2, plunging 13.8%. But so far, the worst by some margin was Spain, which plunged 18.5%. That shakes out according to Capital Economics forecast and modelling for an EU Q2 GDP decline of minus 12.4%. The UK, of course, not technically in the EU anymore. Its numbers are not yet out, but some estimates suggest that there could be north of 15%. Now, the bulls would say that following what has been the worst quarter ever, we could have the best in Q3. But of course, that really does rely on a lot of public health crisis management related issues. There's so much variation between nations and how government policies might change. And what we can see from here is that, for example, a lot of the major banks, just looking at the UK, have started to provision fairly aggressively in expectation of significant defaults, both consumer defaults and corporate defaults. And those corporate defaults do include real estate companies. Lloyds, Barclays, Santander, HSBC, NatWest, the rebranded division of RBS, they've all announced their Q2 numbers recently, and they all are multi-billion pounds worth of provisions. So we should expect to see, unfortunately, a wave of defaults, which are, of course, remember, these defaults are separate to those which are also expected that have come from the government's state loan for coronavirus loans, things like in the UK, like the bounce back loan scheme. And some consultants have estimated what they expect to be the default rate on these coronavirus loans, which are all backed by the government, to be as much as 40%. And so we're looking at forecasting how things could pan out in the coming quarters. Two waves of possible loan default. So what does all this mean for real estate? Well, we should expect to see more insolvencies, more administrations, more CVAs, some forced M&A activity, and some distressed sales picked up by private equity. And actually, what we're seeing already is some of the big boys starting to raise additional capital with a more distressed mandate. We've just seen in the last couple of days that Bloomberg reported that Starwood Capital, one of the biggest kind of NPL investors in the last NPL cycle, it's raising another $11 billion worth for real estate investments, and about 8 is for its next opportunity fund, and it's got an additional $3 billion for these more extreme distress strategies. So we expect to see a bit more of that too.
You mentioned there about how that's drilling down into the real estate side, and we've obviously got Q2 numbers coming through from RCA. I suppose what did you pick up from that?
The numbers have just come out. The headline number again sort of masks a bit more nuance. The Q2 number for Europe is 50.1 billion euros, which is about 1/3 fall on the equivalent quarter last year. But there was a very small handful of mega deals, around the 5 billion euro mark. If you strip out that, we're seeing a lot smaller activity, as we'd expect.
Interesting to see that a number of funds have been raised during the crisis whilst the sort of lockdown has been in place. I noticed that Azora had raised 680 million for a hotels fund backed by APG. And that was interesting because in June, Cristina Garcia Perry was on our Iberia investment briefing, highlighting 3 areas of opportunity, and particularly that hotels and leisure alongside affordable housing and urban mixed use. So it's interesting to see that coming through in terms of the fundraising strategies. Judi, what have you been seeing?
This week we had Unibail Rodamco Westfield come out with their figures, and they're one of the biggest players in the world. But if you look at the numbers, they're not as bad as we've seen elsewhere, like in the UK. All their shopping centres were shut down during the lockdowns, obviously, for 67 days. But the European operations have held up better than their shopping centres in the US. And rents were down in continental Europe by 6.7% compared to 11% overall. So that's encouraging for the European operations. Rent collection for the whole period for the first half was 67%, which was down almost a third from the 94% that they had in Q1. It's a mixed picture, but I think some of the figures were actually quite positive. For Spain, we saw rental income up 29%.
And in terms of RCA, were there any details that struck you, Judi?
I think that the underlying trend that we're seeing is that the number of deals was down significantly. So there was a 55% drop in deals under 20 million.
Yeah, I mean, it was interesting also in an interview with Andrew Vaughan of Redevco to see that there was some optimism coming back, Judi.
What Andrew was saying, some retailers are doing better than others. And what we're going to see, I think, in the coming weeks, months, years, survival of the fittest, and only the strong brands and the local heroes with strong balance sheets, their prospects are looking good. Andrew Vaughan was also talking about potential winners like brands revolving around ethics and obviously retailers with the right mix of in-store and online presence.
Yeah, I think those evolving changes were very interesting. And also just the key point that struck me was that they were now beginning to feel much more optimistic, whereas previously they'd felt that it might be a lost year almost. Yeah. But now, everybody in general is feeling more optimistic about that, and I think that was interesting to pick up. Nicol, what have you been seeing?
Well, James was mentioning earlier about the GDP figures for Italy, which were bad, but not as bad as feared. And there's a similar theme to the transaction volume. Savills just came out with H1 figures for Italy, and 3.6 billion euros were invested, which is 6% lower than the last 5-year average. So not as bad as feared. And in particular, what's significant is that there was a particularly high figure for the second quarter. So as James was saying, because Italy was hit first, it seems to be proving to be more resilient than feared. And we've seen investor interest in particular focused on prime offices, again, mainly in the north, in the Milan area. Over 50% of volumes are focused on offices. And we've seen some very interesting deals with BNP Paribas this week, just bought an office building in central Milan, very near the cathedral, the Duomo, for 100 million, which is fully let to a co-working company. And another deal in the co-working space, a very interesting Italian company called Co-Foundry, which focuses on historic buildings and sort of combines history and tradition with innovation, because what it does, it buys these historic palaces and completely fits them out inside, so they're absolutely high-tech inside, and only uses them for co-working. And they've just bought a historic palace in Genoa to add to the two they had in Milan, and they're going to open another one in Turin next year. And also, still in the office space in Italy, the South Koreans are investing quite heavily. JB Asset Management, which represents Korean institutional investors, has taken a stake in the Eni, the big Italian energy company, their headquarters just outside Milan, for over 200 million euros.
Yeah, I mean, the office sector has been interesting because the view on that has changed significantly over time. I noticed some research from the RICS this week with Simon Rubinson, chief economist, saying there'll be no going back to the old normal. But at the same time, just viewing the death of the office as premature. So it's going to be really interesting, I think, to see how these develop. Thanks very much, Judi. Thanks, James. Thank you, Nicol. Thank you for joining us, and look forward to seeing you next week when we'll look at that aspect of digitization of real estate. Thank you.